Welcome to the Farms.com Risk Management Daily Market Commodity Bottom Line. My name is Mike Casino, Chief Commodity Strategist with Farms.com Risk Management. Well, today we're talking about the potential for a 2015 U.S. corn price rise, maybe a sharp price rise due to falling yields. Here's the theory. There's some analysts out there suggesting that there's been 4 other occasions. You can see the chart here. 92, 94, 2005, 2010, where yields dropped after falling a record corn yield. So 92, 94, 05, 10 were the following crop years where the yield dropped and the price rose. In fact, prior to 2008, prices really didn't move around a lot. You went from the low of $1 to maybe a high of $3. It wasn't until after 2008 that prices became very volatile. So in 2010, following a record corn yield crop year, prices for corn jumped 74% to $6 a bushel. So in 2005-10, the yield dropped by 12 bushels, in 92 by 31, and 94 by 25. So why does that happen? Well, the theory basically is that, during that record corn yield year, it was a wet year, and that wet weather washed away some of the nutrients. Also, a lot of those nutrients were used to produce that record corn yield. The following year, prices tend to drop, less incentive to apply more high expensive inputs, fertilizer, in a lower price environment, and so the farmer complains, applies less, and of course what happens is yield drop. So many are forecasting that 2015 will be the 5th occasion where this may happen. So what we did was we decided to apply a potential drop in yield from 171 last year, and if we apply a 12 bushel per acre drop, or even 13, it doesn't take much. You can see from our corn balance sheet here that ending stocks dropped to 1.1 billion at 159 because demand still remaining quite high. Prices would have to ration considerably higher. Many analysts think we'd go back to 450 this summer. If it's going to be a rally, a sharp rally, it's not going to be until a late summer rally. It could be the second half of 2015. Does anybody remember 2011? Bottom line, this is possible. It's still early, still haven't even just barely started to plant in the U.S., but history does repeat itself. Farmers are humans and they're creatures of habit, and they tend to do the same thing year in, year out. The question is, will they? In the last many years, they've become richer. Land values have gone up. Prices have been good, but are they richer? Do they have more equity? Did they overspend? Did they chase high-priced land? Did they buy that shiny equipment? Maybe they did, some did, some did. At the end of the day, I got to guess that they're going to apply less. That I am hearing from a lot of farmers that work, that are customers of ours, that they are going to spend less. So we'll see what happens. You throw in a dry pattern. U.S. Midwest is dry. It's up 44.99%. In the normally dry to moderate drought category so far this year, it's actually almost worse than 2012 for the same period. The only category that was worse than 12 was the severe category. You throw that on top of lower yields, and you got the recipe for considerably higher prices. Bottom line, we'll have to wait and see again that if that happens. It won't happen until late summer because USDA will not suggest this at any point in time. And you're going to ask, well, why isn't the market reacting? They're short corn contracts. Well, it's because it's early and weather can change. In 2012, the market actually did not start paying attention, did not panic till late June, July. And I think that could happen again this year. In other news, the only other thing we're suggesting is a new recommendation today, or reiterating our recommendation for diesel fuel. We're getting crude oil crossing above the 100-day moving average. The last time we saw crude oil crossing below the 100-day moving average was in August of 2014 at 92.94. So look at the chart here. This is a bullish pattern. We called the bottom on April 7th. We highly recommended booking your diesel at a minimum, filling up your tanks, using the forward booking programs. If you can't use a forward booking program, you can go long futures, either crude contract or a mini. Both would more than cover your needs out 2, 3, 4, 5 years, depending on your volume. If you're a large producer, you can use a crude oil. If you're a smaller producer, just use the mini crude with your broker. If the bottom's in on crude, that means the bottom's in the Canadian dollar, that means bearish for basis long term. So livestock producers need to hedge that Canadian dollar, go long, call option, and also be aggressive on basis. Look for a more detailed recommendation email out tomorrow, April 16, 2015. Until next time, thanks for joining us.